Now that we understand what GST is and kind of how it works, we need to look at how do we process all the debits and credits for it in the ledgers. So GST is going to need a ledger account, and we are going to assume it will always be a liability. Why? Well, that's because the purpose of a business is to buy assets and pay expenses in order to run the business every day. So let's just take a basic example here. So let's say this business has paid cash for the following: rent $9,000, insurance $1,000, and inventory $70,000. And if we add all that up, that has come to $80,000. And that's what every business does. It pays for expenses and it buys assets. And then what it tries to do is it tries to sell those. And what it needs to do is it needs to make sales in excess of what all of its expenses and all of its assets that it's bought have come to. So in this case, this has come to $80,000. So when we have some sales, we'd hope to generate more than that. So, for example, we've got cash sales of $60,000 and credit sales of $40,000. That's a total of $100,000. And what we've done is this: we've sold our inventory for more than it costs to buy all those assets and pay all those expenses, and therefore you've made a profit. We'll look at how profit is actually calculated in more detail later in the course in chapter 10 or 11. But for now, yeah, that's kind of what's happened. We've managed to make more sales than everything we bought. And what that will mean is the GST on that over here that we have received or charged from our customers. So here it is. We've got $6,000 on the cash sales, $4,000 on the credit. That equals $10,000. That would go into our GST liability tab here. So the water level would go up to $10,000. So the business owes the government $10,000 in GST. However, it gets to take out what it's already paid or been charged GST by suppliers. So in that case, that'd be $900 here for the rent, $100 for insurance, and $7,000 on the inventory. That's $8,000. So the water level will go back down to $2,000. However, the business still has a liability. It owes the government $10,000. How did we get that? Well, it received or charged $10,000 in GST, and it paid and was charged $8,000 in GST. And that is why, in theory at least, GST should be a liability, because we should be selling things for more than it costs to buy them and to run the business. And that's just the theory. That mightn't work out like that in reality, and we'll look at that in a second. So what we need to do is the rules of debits and credits. So however you're remembering them, we need to apply those rules. So we're using a Lonray, so we remember them in this order. But if you prefer the Alona method, you just swap revenues and expenses at the end. It doesn't really matter so much for this one because we're just going to go to the liabilities rule, and that is actually the second rule in both systems. So, because we assume that GST is a liability, it follows the rules of debits and credits of a liability. So let's take this example here. When we received the GST of $6,000 on cash sales and $4,000 on credit, that increased our liability. So the rule says when a liability increases, that would be a credit. And when we paid GST, or we were charged it by our suppliers, so that's what these figures here, that would decrease our liability. So that would be a debit. And that's the rules of debits and credits for GST. We're just going to make a little change though. The first thing we're going to do is actually change the name of this account. There is no such ledger called GST liability or GST owing or GST payable, nothing like that. What we're going to do is we've got to call it GST clearing. Why do we call it that? Well, we're going to look at that in a video later on, why it's called a clearing account. Just for now, we're just going to say it is because it is. So in theory, a business should always have a GST clearing account that is a liability, and this is what should happen. When we have it go up, there will be some credits. So on this side, we've got cash sales with GST of $6,000 and credit sales with GST of $4,000. They pop up here. I've just made some dates up for these. These dates were plucked out of thin air. They don't matter in this case. So that increased our liability. And just like if this was accounts payable or loan or something like that, and it went up on the credit side, that would be a liability going up. With the referencing, don't worry too much. We're going to worry about the referencing in future videos, but this is what the references would be. Then this liability would go down every time we pay GST, and that would be for these amounts here, for the GST on the rent, the insurance, and the inventory purchased, and they'd go there. Note the references just say bank, they don't say rent, insurance, or inventory. Why? We'll deal with that in a later video. We'll just say for now that when we pay GST or get charged it, it's a debit. And what we do now is we would balance this ledger out and say, well, how do we balance any ledger? We leave a line and we add up the bigger side, which in this case is actually the credit side. So 6,000 and 4,000 is 10,000. We write that on the same line on the other side, in this case the debit side. And then we subtract away all these debits here. So we're going to subtract away 900 107,000, so that'll be a total of 8,000. So the difference will be 2,000. At the end of January, which is the period in this case, we write the last day of the period, the word balance, and 2,000, and then just like any other ledger, we carry that balance down to the other side on the first day of the next period. 1st of February, credit balance, 2,000, and that is a liability. Liabilities have credit balances. You can see it with the rules of debits and credits there. Liabilities go up on the credit side, so they must have credit balances, and there we go. So in theory, a business should always have a GST clearing account that is a liability. And then we'd have to report that in the balance sheet, because that's kind of the point of ledgers. We use their balances to go on the balance sheet, and that would go over here under current liabilities. It wouldn't go non-current, and it's not an asset. Why current instead of non-current? Well, because in reality, the business has to pay GST owing every 90 days. We don't need to know that, but 90 days is within 12 months, so for us it's always current. But if we had to explain why that was a liability, let's just go through our definition from earlier in the course. First thing that makes a liability is there's got to be a present obligation. What does this mean? It means the business is obligated to settle or pay the ATO, which is the Australian Tax Office, the $2,000 in GST within 90 days. 2. A liability has to result in a transfer in the future of an economic resource or benefit. This clearly will. To settle this obligation in the future, the business will have to give the ATO cash. Cash is an economic resource or benefit. And lastly, it occurred as a result of past events. And those past events were all the transactions that had GST during January. And there we go. GST clearing is an account that's always a liability. Except when it's not, because this could happen. In reality, GST clearing account can actually become an asset. However, it still follows the rules of debits and credits of a liability. What are we talking about? Let's take the exact same ledger. We've got this GST clearing. We're going to take the same numbers for the payments here. So we're going to have cash payments of rent, 9,000 plus 900 GST. Insurance, 1,000 plus 100 GST. And inventory, 70,000 plus 7,000 GST. And we know that when we pay GST, or get charged it by our suppliers, our liability goes down, so they'd all be debits. So they go in there. And all we're going to change now is the other side. We're going to say our sales were not as high. We said a business should be able to sell its stuff, its inventory in this case, for more than it cost to buy all the expenses and pay for all the expenses and buy the assets. So in this case, that was $80,000 of payments here, with $8,000 of GST. But what if, the economy's bad, times are tough, we can't make that many sales. We only make $70,000 of sales. So we've got cash sales of 40 with 4,000 GST, and credit sales of $30,000 with $3,000 of GST. That comes to a total of 7. So that would go there. Just like it did, it increases the liability, just like it did in the previous example, and that means it's a credit. So there we go. What is different now is when we balance this ledger, because the bigger side, this case, is actually the debit side. There are more debits here than there are credits, because if I total these up, these come to 8,000. So just like I did when I balanced the last ledger, I write the bigger total here, and then I write it on the same side on the other side of the ledger, and then I take away the difference. So this is 8,000. I'm going to minus away 4,000 and 3,000. That gives me a balance of 1,000. I write the last day of the period, and the word balance, and then I carry it down to the other side. This is carried down on the 1st of February to the debit side. What does that mean? It's a liability with a debit balance. That seemingly makes no sense. What does that mean? It just means it's kind of like a negative liability, but that's not really a thing. So what we do is we say this GST clearing account is actually now an asset because it has a debit balance. And what we do in our balance sheet is when we do our report, instead of it popping up here under current liabilities, it's now going to pop up here, and we're going to call it GST clearing. And in this case, it'll be 1,000. Why is it an asset? Well, let's just go through the definition from the beginning of the course. An asset is a present economic resource or benefit. What does that mean? Well, in this case, the Australian Tax Office will refund the business $1,000 cash within 90 days. That's definitely current. That $1,000 is definitely an economic resource, so that's an asset. 2, it's got to be controlled by the entity. Only our business has a legal claim to that $1,000. No other entity can control it or go and ask the tax office for it. It's ours. And lastly, it's got to be as a result of past events. And in this case, it'll be all those transactions during January that had GST. So that's really complicated. We've learned a lot in this video. So let's just try and summarize it. So the GST clearing account is the name of the ledger for GST. It follows the rules of debits and credits of a liability, but depending on the transactions for the period, it can end up being an asset or a liability. So let's take that first situation. We had sales over here, and the GST clearing account, the liability count went up. It went down with the payments, and in this case, the amount of GST we received or charged was more than we paid, so we ended up with a liability of $2,000. If we could just summarize that, we could say, so when the GST received or charged by the business is more than the GST paid or charged by suppliers, the GST clearing account will be a current liability. And then we had the opposite situation. In this case, we had sales and cash sales and credit sales with GST only came to $7,000, and the payments or the amounts we got charged by suppliers came to $8,000. And when we balance this one out, this one ended up being an asset. So we could summarize that by saying, and when the amount of GST the business pays or gets charged by suppliers is more than the GST received or charged by the business, the GST clearing account will actually be a current asset. So GST clearing is one of those accounts like bank that can be a current asset or a current liability. We just need to apply these rules here. So this is going to be a really good note that we can take here just to summarize everything about how GST clearing works.